Hey everyone, it's Tim Reazor with Revere Asset Management. It's 3:20 here on a Wednesday night. So very quickly, stock nerds, market lovers, before you and I begin tonight's sojourn, real quickly, I don't want to vary the lead. So I want to show you a picture of what the Fed's doing with demand destruction that drives the next leg lower in the S&P 500. Okay, I'm going to build you up to that picture as we progress through this video, but we got to start. What we'll do is we'll start at one place, and then by the time I'm done, I'll show you my thought process, understand what drives us to that next leg lower, and we'll have some fun, you and I, along the way. So, but very quickly, before we begin, listen, I tell you what, I'm really grateful for the opportunity to serve you, to do videos for you. You interact with me. I'm really grateful. And if you have any questions about what we do here at Revere, like Don did this really well-received, great interview recently. If you want that link, it's Bear Market Survival Secrets. It's on our website. You can find it right here. If you have any questions, concerns, or comments about anything that I say, or Don or Hunter, or you hear Danny talking, or you have any questions about the portfolios, all you have to do is go to revereasset.com, go to About, go to the word About strategy, and then you just scroll all the way to the bottom. And then there we are. There's America's Fiduciary Danny, there's Don, there's Hunter, there's Meryl, and you can get a hold of any one of us. If you're on your connected device, you'll notice a little hand sign here right there. You can just touch that and it'll connect you to Danny Stewart right away. And then look, if you're getting this video on YouTube and you want to subscribe, we'd love for you. And by the way, when you subscribe, it's free. We give all of our strategies away for free. We tell you what we're doing for free, understanding that we are with the understanding that we're here to enable individual investors, and understanding that once we have trust and you watch what we're doing every day with 100% transparency, then whether you're too busy, your friends, the people you love, your loved ones, you'll recommend us to them. All of our business, by the way, is word of mouth. We don't advertise, and it's because of you. And for that, we are eternally grateful. I know I am. And so if you want these videos delivered right to your inbox or someone you love, all you do is go to subscribe, hit submit once, please. And the video that you're watching, the once a week podcast, we do content 6 nights a week. That's all we ever send out. You're not in a sales cycle. You'll notice that there's nobody here that's a salesperson. Nobody on our team is a salesperson. This is our team. Like, well, that's a very small office. It's imagine what you can accomplish with such a lean and hungry mentality. So with that, stock nerds and market lovers, let me see here. Oh, if you want to get you know what, a lot of what I'm doing in tonight's video was driven by someone who wrote in. And how'd they find me? They found me on Twitter. And so at TJ Reazor is how you find me. And if you want to DM with me, my DMs are open. So if you want to reach out to me, like email's a little slow for me sometimes because I get a lot of emails. Twitter, this is like texting, you and I back and forth, just quick text. I don't tell you what to do by no means, but we have conversations. And so if you want to do that, at TJ Reazor on Twitter is absolutely how you find me. And stock nerds, market lovers. These videos, they are for what? They're edification purposes only. They are never ever to be misconstrued advice. When advice, advice, seek advice, please, please, please reach out to us via email or in fact hit that little phone button and give us a call. So real quick, let's take a look here. I've got something interesting where I'm going to tell you that when the VIX is high is when you buy, and when the VIX is low, it's kind of no go. But how about the dollar? Let's take a look at the dollar here. And so a lot of people say, Tim, can you show me a correlation of dollars? So like, if dollar's high, watch out for stocks. Like the market didn't get destroyed today, but yet here the dollar was up 0.5%. And sometimes the dollar's up 0.5%, the market gets destroyed. And let's just take a look and see. It's not thinking that there's 100% correlation. It's understanding what the trend is and what the relationship is between the correlation and the overarching trend of the S&P 500. So here's 2022, and you can see this is the S&P on the bottom. This is hard to see, but I apologize. This is the dollar up here on the top. And so here you can see a dollar starts out, the S&P starts out strong. What's the dollar doing? Yeah, it's coming off. Dollar hits a high up here, and what does the S&P do? Comes off. Dollar continues to go higher. What does the S&P continue to do? Yeah, the trend is lower. Dollar is choppy. It almost mirrors, right? Look at this acceleration of the dollar, deceleration of the S&P 500, comes off, goes up, and then what happens here? Goes up, comes down. And now we're kind of in, oh, excuse me. Let me get that marker off there. Well, I still want to draw. Now we're in this pattern right here, okay? And so are we going to break out higher, or continue the next leg lower. I want you to keep that thought in mind, because it's interesting, because it's not going to be instantaneous, all right? But it's interesting because when I show you this chart, it's like, well, there's something that I think you should see with the VIX, because the dollar is, you know, I wouldn't say it's a fast moving animal, but it's exerting pressure on the market, but so is the VIX. And so you hear me say I like the VIX futures more than anything else. But here is a way to use what I would refer to as the cash VIX, people's VIX that nobody knows how to use, because what number is this number too high or too low for this market? Based on what? And like the VIX was down today, right? And like, but there's so much volatility. And look, I think this is indicative of a market that's well hedged. That's it. So I could be wrong, but I think that to get the VIX really going higher here, it's got to be some kind of extraordinary event right now. And we might get that. I'm going to lead up to that here in a few moments. So what I'm showing you here is 1-3. We're on a daily chart. That's the S&P 500. And 1-3, this is a chart of the VIX. And so the VIX are the price bars, not the candles here. And so when I'm looking at a low VIX starting the year, what happens? The S&P 500 comes down. And here we get like a high VIX and the S&P 500 goes up. And here's another period of high VIX. You get a rebound. Now, I'm not saying these are take you to new high rebounds. I'm just saying VIX high, you buy potentially. And it's counterintuitive. It's just another way of looking at information. I'm not telling you what to do. I'm giving you a different way to take in the whole picture. Something to think about, because when the VIX is this high, what are you hearing on TV? What are you seeing from Twitter commentary or whatever your news source du jour is? It's gonna go low. We're gonna die in a plane crash. And gosh, I hope you don't do that. But look, VIX high, and look at the S&Ps. Okay, VIX low, and what do? VIX high, price bars. What happens to the S&Ps? They go lower. VIX comes off a little bit, like right here, and the S&Ps recover. VIX higher right here, S&Ps come down. And right now, and these are just standard Bollinger Bands. Like, what are those lines on your charts? And those are magic lines. They're not magic lines, I swear to God. They're just standard Bollinger Bands that look like the letter E right there. For extra special Bollinger Bands. No, they're just normal. And so, well, what do we do right here? We're just at the mean here of the Bollinger lines. And yeah, this is the decision for price. And well, what's that decision going to be based on? Well, tomorrow's a big number, right? So let me get this back to this chart right here. So tomorrow is a number. There's a personal consumption number coming out. It's CPE. It's an inflation number. Okay, you got core, and then you've got the real number. Then you've got like the bigger number. And it's interesting to me, you know, and it's no secret what the Fed's doing, right? They want to raise rates, but they really want to do what? They want to create demand destruction. They want to crush assets, whether it's copper, whether it's your 401k. They need the wealth effect to stop so prices can come down. And so make no mistake, that's what they're trying to do. But we can debate how successful they've been for a while. But it's interesting what's happening. Here's crude oil, okay? And I'm telling you, I've been thinking based on charts I've been showing you, have we peaked in inflation? And look, they haven't. If inflation has peaked, has the Fed done their job already? And could that create the soft landing that the Fed desperately wants, or are they going to throw us into a recession? And I say we got to let it play out. I mean, I hope we don't go into a recession. I hope no one feels pain, but the Fed's a blunt force instrument, man. I mean, they're not a scalpel, but the one way to lighten the load here on consumers is to get energy prices lower. And so if we look at crude, has crude peaked? And so here's crude oil on a daily chart, back at May's highs, March's highs, can't eclipse them here. And now we're broken through the 21, and I think we're on our way to the 200, okay? And well, what would cause that? It's bad. What would cause it? It's deflation, right? Like we're scared to go anywhere. We're scared to spend anything. 70 to 80% of this economy is consumer based, meaning we're a service based economy. We need to go out and spend. And if we're scared to spend because the Fed has caused destruction, demand, right? Demand destruction, because we don't want to go out and we want to just hoard dollar bills, y'all. Yeah, that's going to cause prices to come lower. And where can you see that? In another chart you and I have been studying, RBOB, right? Gasoline futures. And so gasoline futures for 2 weeks have been coming off. You're like, well, I don't feel that at the pump. Gas, well, at least for where I'm at, has come off its highs by 40 to 50 cents a gallon. And so I don't know about where you live, but where I'm at is about 40 to 50 cents a gallon. That's a pretty big move. And so gasoline has peaked. And well, has gasoline peaked? You tell me, what are the good reasons gasoline has peaked, right? Like, well, we're drilling more, like we're opening up the spigots, more pipelines, more fossil fuels for the midterm until we get to the next technology. Or the Fed has created a ton of demand destruction already, and it's now showing up in the fact that we don't want to go anywhere. But planes are packed in, and so I get you. It's a mixed picture. Look, the Fed's going to, this doesn't stop the Fed. The Fed wants to snuff out, it's like a forest fire, right? Like it's got to snuff it out, overkill, more water, more fire crews. They're not done here. But you're starting to see some commodity prices breaking. That's what I want to point out to you. How about LBS? By the way, all of this, I believe, what I'm showing you drives the next leg lower in the markets, not higher, and I'll get to that in a minute. Here's lumber. Look at how high lumber was, right? Lumber breaks. How about, let's look at KE. So here's wheat, and then we'll look at corn here, XC. And so, yeah, like we're seeing lower prices right now in some real key commodities. And so does that mean that people are now, you know, they're kind of climbing in the bunker, the spending bunker? And if we're climbing in the spending bunker, that is not good for a service-based economy. And so there's a group of stocks that have already experienced what the Fed wants the rest of the market to experience. So let me show you those stocks as I build this picture up here. Oh, by the way, big announcement, totally forgot. Wanted to say this at the beginning of the video. Tomorrow, we're going to absolutely be taping the podcast early. So we're taping this. So if you want to get the podcast real quick, let me show you. So you go here, Tomorrow's Insights, and you can get all of our podcasts. If you're new to our work, I implore you to go back and start at episode 400, okay? I've had a few people write into me telling me, hey, I started at episode 400 like you told me to, and you really built up our picture or my picture, whatever they said, messages to me. I appreciate that. I think if you give it 6 episodes, I'm telling you, I'm not saying you're going to be hooked, but I'm thinking you're going to be hooked, because the way I look at markets, the way Don looks at markets, what Hunter brings you and what Danny has to add, it's just different than what's out there, and it's everything that we're doing. And if you have like, well, I already have an advisor, it's me, or I have an advisor and he's with Merrill Edward Jones, and great, take what we're doing and call it. And if you're not happy with the person doing your business, show them what we're doing. I implore you, there's like questions to ask these advisors, right? Like, hey, what's your sell discipline? What gets you into a market and what gets you out? And then compare it to what we tell you and what we think. And I think you'll see a very clear difference and a very clear picture. Okay, so let's look now at weekly charts, okay? And so what gets us to this next leg lower? And I've shown you that oil is coming off, gasoline's coming off, and I'm gonna contend, I'm gonna go out on a limb here, and I could be wrong. I reserve the right to be wrong. The best part about the markets is every day you get a new piece of information and allows you to shape your opinion, and you can change your opinion. You're not unless you're trying to build a media personality off of fixed, finite, you know, I'm a grump, I'm a bear, no, you don't have to be like that. That's TV land, that's Twitter land. You're not trying to be some kind of personality that people glom onto. You're trying to make money in the markets, and that's what it's about, right? Making money in the markets, not trying to be right in the markets. trying to make money in the markets. Those are two very different things. Maybe we'll explore that in the podcast tomorrow. So let me show you. So here's the chart. Let's go crude oil chart, right? And I say if this chart breaks the weekly mean, you're probably coming down to this 10-week area, okay? Down here, so we'll just call this the zone of 90 to 88, okay? If oil breaks and it comes down there, I think it takes the S&Ps to the next leg lower. And let me give you those levels. What is the next leg lower? But first, let me show you a chart that's already done what I think the S&P 500 is about to do. And so this is a weekly chart of the Nasdaq 100, not the entire comp, but the top 100 stocks in the Nasdaq, okay? And so here is a Fibonacci retracement. So you can go from high to low, and the key areas that I'm always concerned about on the downside, like, are you going to break the 50 or the 618? If you, and these are like cattle prods, right? They just herd, they're fences. You break through the 786, you probably come to the 618. Break through 618, probably come down to 50. Look at this. We are now trading in the zone of the 50% retracement. It's normal to do a half back retrace. I've studied these markets for a very long time. You can go back, whether it's a 2-minute chart, a 2-month chart, a 2-year chart, a weekly chart, a 2-week chart. You give back typically 50% of the move, okay? And then depending upon what kind of trend you're in, do you go higher or lower? And so we're in a downtrend, right? And so this is proceeded to be with some really sharp rallies, right? This is, taking you lower. And so, but is this all the Nasdaq has? I mean, a lot. I mean, the damage that has been done to the Nasdaq 100 stocks, right? You know that. Can it absolutely go lower? Sure, it can. Does it get down here to the 40 week? Sure, it can. It can do anything, right? Rally like a bat out of hell, like meatloaf, like a bat out of hell. And so, but the S&Ps haven't done that. And so the SPX, where has the SPX stopped? Stopped 50% retracement, right? Excuse me, 618. It stopped. Let me just be really clear. The S&Ps have stopped at the 618. They're not down here at the 50% retracement. The normal move to give back 50% of this high from the COVID lows, this low from the COVID lows to this recent high in 21 or 22. So what would drive the S&Ps down to 3505? And can we go lower? Sure, we can go down much lower. But the next leg lower, I believe, is down to 3,500. And what drives that move lower? The last bullish bastion of hope, crude oil. And it hasn't broken yet on a weekly chart. Starting to on a daily. But if this is the fire off short, if this consolidation fires to the downside and you see 90 to 88, the next leg lower in the S&P 500 is most likely going to take you down to 3,500. That's 200 more S&P points. And you're like, I don't talk S&P points, Tim. I talk Dow points. Oh, pardon me as I try to mute my phone. That I'm going to struggle to do. Well, it's just going to ring, and I apologize for that. But what takes us down here to 3,500? That crude oil chart, and one S&P point is equal to 8 Dow points. So you're looking at another possibly 1,600 points lower on the Dow or the YM futures if you're looking at the YM futures. So we could have some sharp rallies, but if you see what is going to be what I think is, they've got the inflation now, and if they kill demand, it's probably going to cause some disinflationary pressures, and that is extremely troublesome for an economy that relies on you and I going out to spend. So with that, I hope it helps. Any questions? Feel free, please. I encourage you to send them my way. With that, I'll see you on the next update.